Hey, what's going on, guys? Today I wanted to give you a quick tutorial on how to provide liquidity on Aerodrome. Aerodrome is a very popular VDEX, and there's a bit of difference when it comes to like a VDEX like Aerodrome when compared to a normal DEX like Uniswap. So let's go through that here. Basically, if you're looking to provide liquidity, what we're going to do is go to this liquidity tab. And there's a bunch of liquidity pools here, right? And what we want to think about is if we want to actually provide liquidity for concentrated liquidity pools or actually provide full range liquidity. So Aerodrome actually has full range liquidity as well. If you go to the type here and then click basic, you're going to be filtering all of this full range liquidity pools, right? And you got to be bullish on the underlying asset to be providing liquidity. Like, for example, you find that, okay, this ETH and MS ETH here seems pretty good. And MS ETH is like a synthetic ETH that you could look into. And then it's providing us a 6.37% emission APR, right? So assuming that MS ETH is safe, it's quite a good APR compared to just maybe lending out your ETH or staking your ETH. But then there's also volatile pairs like ETH to USDC, or if you want to invest into Aero, there's Aero to USDC, right? And then there's also higher risk stuff like maybe virtual ETH or these other tokens that are on Base. So Aerodrome currently is on Base, but I believe they are expanding to other chains like ETH mainnet as well. And what we can do here, if we want to provide liquidity for Aero to USDC, we want to hit new deposit, and then we want to put whatever amount that we want to provide liquidity for, right? If I have some Aero in my wallet, and again, this is just a demo wallet. I don't keep a lot of money in my demo wallet. You're going to hit deposit, and then it's going to ask you for approval to withdraw your asset. Then you could just deposit there, right? And what you're going to notice is that it's going to ask you for like a 50-50 ratio. If you're providing liquidity for a full range LP, if you put like $1,000 in USDC, you have to buy $1,000 worth of Aero, right? And before you actually deposit, you could swap your assets over here. You could be swapping whatever asset that is on the Base network, like for example, USDC or Coinbase Bitcoin or ETH, into Aero before you actually deposit, right? So that's very straightforward full range liquidity. And then after you add the liquidity here, what you're going to see is on the dashboard tab, you're going to see your liquidity pool position. Then from here, it's going to actually accrue some trading fees. And if I hit claim here, you're going to see that I would be earning both Aero and USDC, right? If that's my goal, then I don't want to be staking my liquidity. But if my goal is to earn some Aero emission, which is around like 26-27% APR right now, I want to be staking my liquidity. So if I don't stake, then 10% of the fees that I get would be distributed to the pool voters, right? I made a video on how VDEXs work recently. So if you want to learn more about that, you could check out that video. If you stake your liquidity, your trading fees would go to the V-Aero voters, right? What you could do is you could lock your Aerodrome token and then vote to incentivize these pools. And then from voting, you get the trading fees, and the people that provide the liquidity would get the Aero token emission instead, right? So you're kind of like swapping the fees for some Aero, and then you could decide to unstake at any time if you decide to exit this position. But full range liquidity compared to concentrated LPs is quite low risk. So earning a 20-something% APR is quite good. But the thing to realize is that we have to be holding a 50-50 ratio of USDC and Aerodrome, right? But this could change if Aerodrome goes down in price. You're going to be ending up with more Aero, and then your USDC would be slowly basically converted to Aero as the price goes down. But because Aerodrome is reducing in value in US dollar terms, the actual ratio is still 50-50, right? So let's say you deposit like $500 in USDC and $500 in Aero. If Aero goes down in price, you might be ending up with like $900 or $800 of liquidity, but then the ratio would be still 50-50, right? If your LP value is at 800, maybe 400 is USDC, and then another 400 US dollar is an Aero token. So that's something to realize. And I could run through the simulation for you really quickly here. Let's use 100K just to make the number more simple. And usually the best way to provide liquidity is to run some simulations before you actually deposit. So if I put the upper range to be pretty much close to infinity here, and then the lower range to be at 0. And let's look at the arrow chart here. So if Aerodrome is trading at 0.67, and I'm happy to buy some Aerodrome at this price, I could choose to enter into a full range liquidity pool, right? And then maybe the max upside that I would expect in the next 6 to 12 months, if this is a shorter term position, then I could set my target to be at around like 1.4 or 1.5, right? So I could take a look at that really quickly. So let's say we deposit at 0.68. And that's the current price. And then I want to go to this setting tab on the top right to kind of adjust my chart a little bit. So the x-axis is the Aerodrome price. I could put this at 0. And then let's put this at 3 for the maximum price. And then for the y-axis, I could put at 0 and then 150K, right? So it's going to show up like this. And then we could adjust the chart here. If you want to adjust the x and y axis, just hold on to the shift key on your keyboard and then scroll the mouse wheel, and then you're able to see a nice looking chart. And what you could do is you could actually save this chart, right? If you log in with your Gmail or something, then we could actually quickly go back to this chart if we need to. But what I want to show you guys is if Aerodrome, let's say it goes down in price by 50% from this price. So let's say we drop to 0.34. What you're going to notice is that our LP value would go to 70.7K, right? Because our USDC is slowly getting converted to Aero, but you can see the ratio of deposit is still around 50 to 50 in US dollar value. But if you held the asset separately, you would have 75K, because if you bought 50K worth of Aero at the beginning and the price goes down, your Aero holding would drop to 25K, right? And then your USDC is still going to stay at 50K. So then you would have 75K worth of liquidity. But this is what we call impermanent loss here, 5.8% of impermanent loss. That's the difference between like whatever you hold, if price goes down or up, compared to if you were providing liquidity. Because inside the liquidity pool, your assets are being converted, right? That's how they actually allow traders or investors to swap tokens. You need to allow for that exchange to happen. So if my APR over a year is above like 6% and I plan to invest in Aero for at least a year, then it makes sense to be providing liquidity if I want to hold both like 50% USDC and then also 50% Aero, right? So that's not bad at all. So my max downside is about 30% if I expect the price to bottom out at, let's say 0.34. If I go to the chart, that is a pretty reasonable bearish target for Aero here to actually go down to, right? And we never know when a token is going to bottom out. But the nice thing about full range pools is that you're going to be in range all the time, and then you're going to be earning yield all the time, right? And what we could also do is when the price dropped to be pretty aggressively low, we could choose to add more capital with either the fees that we've earned or outside capital into the pool to kind of lower our cost basis as well, right? And then let's simulate if the price goes up to, let's say we were saying like 1.4, that's the max upside that we could expect maybe in the next 6 to 12 months or so. And of course, if we held it separately, we're looking at about 50 to 53%. And if my APR is greater than this 6.2% here, it would be worth it for me to actually provide liquidity if I could actually yield farm that for at least a year, right? So you can see sometimes even full range liquidity would give you a pretty good risk to reward because you're taking much less risk, even though the APR is slightly lower. But in this case, the APR is still quite high for a full range LP, right? It's still around like 26, 27%. You can't really get that with a lot of other DeFi investment. So that's why providing liquidity could be quite powerful. But you got to understand like the different concepts like impermanent loss and what to do with the fees and stuff like that, right? That's basically what I teach at Drippy, how to actually provide liquidity effectively and how to actually make a profit in the market long term, right? Because a lot of liquidity providers, they would just go to this liquidity tab And then maybe they are providing concentrated liquidity, right? Stuff like ETH to USDC. We could take a look at this pretty quickly here, but then they see like a higher APR, right? And then maybe this is like 33%. And sometimes the APR estimate is not very accurate. And some people would even go tighter to like, 90%, 100% APR, but your LP is actually quite tight and you could get knocked out of range all the time. And then you would suffer much, much more impermanent loss than the fees that you would earn, right? If you actually go to this autopilot tab, you would actually be getting a pretty decent APR. And then they manage the liquidity pool for you. But in my opinion, and from my experience of yield farming for a few years now, a lot of automated tools actually do not provide liquidity really well, and you would actually end up losing money over time. So I personally would avoid this autopilot function. It could seem really good, but most of the time it just loses money over time. So you guys could look at the different pools and kind of look at like the different APR, the emission APR. And again, you don't have to stake your liquidity, right? If you just want to earn the trading fees, you don't have to stake the liquidity. You could go to this liquidity tab. You can see I could stake at any time, or I could just keep this position and not stake it and then earn both USDC and Aero, right? And it works the same with concentrated liquidity. But again, for concentrated LPs, you kind of need to be a bit careful with how you set your range, right? So if I'm providing liquidity for something like ETH to USDC, what I personally like to do is look at least like the weekly chart or the monthly chart to be setting my ranges. What a lot of people do is they set their ranges really tight. Like let's say they're setting the range at like 3,300 and then the bottom range could be at around 2,400, right? Of course, the APR is going to be higher, but if you just look at like the previous price action, Ethereum's price actually don't stay in range for very long in like a $1,000 zone, right? So you're going to get knocked out of range all the time. And then even if you're hedging with stuff like perps or options, a lot of times the hedging cost is just not worth it. You could easily be liquidated if you're using perps with a stop loss. And then you're going to be in a tough spot. And it's just very hard to make a consistent return, especially if you are a more passive liquidity provider, right? If you have less than 6 figures, it's probably not worth your time to be like squeezing the range and trying to maximize the APR. And because a lot of these strategies don't necessarily even mean higher profits, right? If we're looking at concentrated liquidity, we could be simulating ETH to USDC. And let's just say we deposit at 2,300 to 3,300, and then the current price is at $3,000, right? So this is more of a bearish range where the bottom range is a little bit wider. But if I want to adjust that to a more 50 to 50 ratio, I could adjust my range to be at around like 2,500 to 3,500 here. It's not exact, but let's just roll with this. If Ethereum's price goes down by 50% from here, what you're going to see is that you're going to be suffering a whopping 32% of impermanent loss, right? And then if the price goes up to 4,500, you're going to be suffering about 15, 16% of impermanent loss. And it might not actually seem like a lot at beginning because maybe you're earning like 100% APR, right? But at the same time, if you're locking in impermanent loss all the time, if you go back to the ETH price chart, you gotta realize that the APR metric is over 1 year, right? And you can see if you set a $1,000 wide range, you're most likely going to be rebalancing more than like once a year. So you're going to be locking in much more than like, let's say 17 to 30% impermanent loss if you are basically tracking the range. But if you're using different strategies like trying to minimize the impermanent loss, you're going to be lowering your APR or actually using stuff like perps. It's going to eat into your profit margin, right? So that's why I personally don't prefer tighter range liquidity. So what we could actually do is we could estimate our APR with a free tool like Crystal, right? If we go to ETH to USDC, and you guys could use Metrics Finance as well. It is paid. It is a good tool if you could afford it. But let's say you're just starting out, you could be using something like Crystal, right? And you could be estimating your APR of, let's say, you want to provide more narrow or wider range here. Let's just use like 2,500 to 3,500, like what we were saying. If you went in with a tight range liquidity, you can see that the APR estimate is not really accurate sometimes, right? Right now it's at 2%. So maybe Crystal is not the best for Aerodrome pools. And then you could look at the APR tab as well. This is like basically the pool APR. You can see that the actual APR of the pool might not be as good as like if you were staking the liquidity and earning the arrow emission for these couple of days, right? But sometimes the pool fees are better than the arrow emission. So then it makes more sense to not stake your liquidity rather than staking your liquidity if you were providing liquidity here. But let's say we are using Metrics Finance here to simulate that pool. I can tick on Aerodrome and then tick off Uniswap. It's going to switch over to base. And then I could pick like, for example, E to USDC here to simulate the performance. And then I can zoom in here a little bit. And then let's say I set the range at 2,500 to 3,500. And then we could change the calculation method to be, for example, peak of liquidity. Of course, because a lot of people are squeezing the range here and kind of providing really concentrated liquidity, your APR is going to be really low at 3.5%, right? But let's say the price is really volatile, then your APR would spike to about 70 something percent or even 100%. But it's actually quite difficult to estimate the APR of an Aerodrome pool because again, there is like automation tool that basically squeeze the range for you, which would cause a lot of impermanent loss and it's just really bad for wide range liquidity. So you might not want to be providing liquidity into this specific pool, right? But that's the overall process that we should be going through. We should be, for example, looking at the chart, running the simulation and see like, okay, what is the potential profit that we could be getting? And what is the potential loss that we could be getting with our capital, right? I always do this before I deploy. And then when we're ready to deploy, it's actually quite simple, right? You just set your range here. Let's say you go with a tight range liquidity. It is going to show you like the ratio of deposit, right? Let's say I want to put in 1 ETH, then I would actually need to swap this amount of USDC here to actually pair with my 1 ETH. And again, I don't really recommend like a tight range liquidity, especially for beginners and you don't know what you're doing. Most tight range liquidity providers end up losing money over time. And another way that you guys could track like the APR is to kind of manually calculate, right? Let's say you deposit it today, and then over the next 30 days, you could monitor the fees and kind of calculate the APR based on the capital that you deposited. So that's pretty much it when it comes to providing liquidity on Aerodrome. If you want to provide liquidity for lower risk pools, then go with these basic pools, right? Maybe USDC to Aero or even ETH to USDC. It's pulling a pretty good 11 to 12% APR on like a full range LP. And you want to be comparing these APR with other DEXs, like for example, Uniswap, to make sure that you get the highest APR for taking the same risk, right? We don't want to be yield farming in pools that basically have the same assets, but then maybe the APR is not as good. You're basically taking the same risk, but then not really getting the full rewards, right? And then if you want to provide concentrated liquidity, again, be careful, but you can look at these pools, like for example, Coinbase Bitcoin to USDC, and then decide to see if it's actually worth it to provide liquidity, right? And again, the biggest downside with Aerodrome liquidity is that a lot of the liquidity pools are providing really tight range liquidity. And in my experience, again, they just end up losing money over time if the market is really volatile. So just be careful. I personally, again, would not use this mellow vault. And after you deposit, you could choose to stake to get the arrow rewards. Or if you just want the trading fees, then you don't have to stake, right? So that's it for Aerodrome. I hope that was helpful. If you want to learn more about providing liquidity and yield farming, earning passive income with your crypto holdings, be sure to check out the other videos on my channel. I go into detail on how you could start doing that and then how to actually optimize your strategy over time. And if you want me to cover other protocols as well, then feel free to let me know down in the comments as well. Thank you for watching. I'll catch you on the next one.